Have you ever wondered why so many financial experts say you shouldn't try to pick individual stocks? It sounds strange at first. After all, we constantly hear stories about people making huge profits from buying companies like Apple, Amazon, or Nvidia early. But hey, the surprising part. Even professional investors often struggle to consistently beat the market. That's why millions of people choose a much simpler strategy called investing in index funds. In this video, I'll explain exactly what index funds are, how they work, why they're so popular, and whether they're a good choice for beginners. By the end, you'll understand one of the simplest ways people invest for long-term wealth. What is an index fund? Let's start with the basics. Imagine you're a football fan and someone asks you to predict which team will win the league this season. You could spend hours studying each team, comparing players, and trying to guess the winner. But there's another option. Instead of betting on one team, imagine you could own a tiny piece of every team in the league. No matter which club wins, you'd still benefit because you own a share of all of them. That's essentially what an index fund does. An index fund is a type of investment that follows a group or index of companies. Rather than trying to choose the next big winner, it buys shares in all the companies that make up that index. One of the most famous examples is the S&P 500, which tracks about 500 of the largest companies in the United States. So instead of buying just Apple or Microsoft, an index fund owns a small piece of both, along with hundreds of other companies. Think of it as buying the whole fruit basket instead of trying to guess which single fruit will taste the best. Let's make this even simpler. Imagine you invest £100 into an S&P 500 index fund. Your money doesn't all go into one company. Instead, it's spread across hundreds of businesses. A small percentage goes into Apple. Another percentage goes into Microsoft. Some goes into Amazon. Some into Google. Some into Coca-Cola. Some into hundreds of other companies. If one company performs badly, the others can help balance things out. That's one of the biggest strengths of index investing. As companies grow, the value of the fund generally grows too. If new companies become larger and more important, the index adjusts over time. In other words, the fund automatically keeps up with changes in the market without you having to constantly buy and sell investments yourself. Why do so many investors love index funds? There are several reasons. First, diversification. You've probably heard the saying, "Don't put all your eggs in one basket." If you invest all your money in one company and that company struggles, your investment could lose a lot of value. But if you own hundreds of companies, one bad performer has much less impact. Second, low fees. Because index funds simply follow an index instead of paying teams of analysts to pick stocks, they're usually much cheaper to run. Lower fees mean more of your money stays invested. Third, simplicity. You don't have to spend hours researching companies or watching the stock market every day. Many people simply invest regularly and let their money grow over time. Fourth, long-term growth. Historically, broad stock markets have grown over long periods, although there have been many ups and downs along the way. That's why index funds are often considered long-term investments rather than quick ways to make money. What are the risks? Now, it's important to remember that index funds are not risk-free. The stock market doesn't only go up. Sometimes it falls. During economic crises or recessions, index funds can lose value, sometimes quite significantly. That's completely normal. The key difference is that long-term investors expect these ups and downs and don't panic every time the market falls. Another thing to remember is that index funds won't make you rich overnight. They're designed for patience, not instant success. If you're looking for quick profits, you'll probably be disappointed. But if you're willing to invest consistently over many years, index funds can become a powerful tool for building wealth. A simple real-life example. Let's imagine two friends. Sarah invests £100 every month into an index fund. Tom spends his time trying to find the next hot stock. Some years Tom does really well. Other years he loses money because he picked the wrong companies. Sarah doesn't worry about predicting winners. She simply invests every month, whether the market is going up or down. Over many years, Sarah benefits from two powerful ideas. She keeps investing consistently, and her money has more time to grow through compound returns, where your investment earns returns, and then those returns begin earning returns too. It's a simple strategy, but over decades it can make a huge difference. Common myths about index funds. One common myth is that investing is only for wealthy people. That's simply not true. Today, many investment platforms allow people to start with relatively small amounts of money. Another myth is that index funds guarantee profits. They don't. No investment can guarantee returns. What index funds offer is broad diversification and a simple way to participate in the growth of many companies over the long term. So let's quickly recap. An index fund is a single investment that owns small pieces of many companies. Instead of trying to beat the market, it aims to follow the market. It's simple. It's diversified. It usually has low fees. And it's one of the most popular long-term investing strategies in the world. That doesn't mean it's perfect, and it certainly doesn't eliminate risk. But for many people, especially beginners, it provides an easy way to start investing without needing to become a stock-picking expert. If this video helped you understand index funds, don't forget to like, subscribe, and turn on notifications. Thanks for watching, and I'll see you in the next video. Remember, wealth is built through progress. Keep progressing, progressors.